This video is for general educational purposes only and should not be considered financial advice. Always do your own research and consider seeking professional advice before making investment decisions. Imagine hearing about a company that everyone is talking about. The news says it could be the next great investment. Friends are discussing it. Social media is full of excitement. The share price surges on its first day of trading. You have fear of missing out, thinking, if I don't buy now, I'll miss out. Unfortunately, this is where many investors make one of their biggest mistakes. While some IPOs become fantastic long-term investments, many experience significant price swings shortly after listing. In this video, you'll learn what an IPO is, why they often become so volatile, and how understanding the IPO cycle could help you make better investment decisions. IPO stands for Initial Public Offering. It's the first time a privately owned company offers shares for sale to the general public through a stock exchange. Before an IPO, ownership is usually limited to founders, employees, and private investors. After the IPO, anyone with a brokerage account can potentially become an owner. Companies choose to go public for several reasons. They may want to raise money to expand the business, develop new products, build new facilities, reduce debt, or allow early investors to sell some of their shares. Going public also increases a company's profile and often provides easier access to future funding. Many IPOs involve companies that people already know and admire. Some investors hope they're buying the next Amazon, Apple, or Nvidia. This excitement creates enormous demand for shares. Sometimes demand becomes so high that the share price rises dramatically on the very first day. But here's something every investor should remember. A great company doesn't automatically make a great investment. The price you pay matters just as much as the quality of the business. Even an excellent company can produce disappointing investment returns if investors pay too much. Many IPOs follow a similar pattern. First comes anticipation. Months before the listing, media attention builds. Financial news covers the company almost daily. Social media creates excitement. People begin talking about the opportunity. Next comes the IPO itself. Investors rush to buy shares. Demand often exceeds supply. This can push prices sharply higher. Then something interesting happens. The excitement begins to fade. Investors stop focusing on headlines and start looking at the company's financial performance. They ask questions like, can the company justify its valuation? Will profits continue growing? Is future growth already reflected in today's share price? In many cases, the share price begins to settle as excitement is replaced by reality. Eventually, the company's long-term performance depends less on the IPO and more on how well the business actually performs. A great current example is the recent SpaceX IPO. It attracted enormous attention from investors around the world. Many people wanted to own a piece of one of the world's most innovative companies. Strong demand pushed the share price sharply higher shortly after listing. But like many IPOs, the price has also experienced periods of significant volatility as investors reassess what the company may be worth over the long term. Now, this doesn't tell us whether SpaceX will ultimately be a great investment. It may well become one, or it may not. The important lesson isn't about one specific company. It's understanding that excitement can move prices far more quickly than business fundamentals. Buying simply because everyone else is excited can expose investors to unnecessary risk. Another important concept to understand is the lockup period. When a company first lists on the stock market, founders, executives, and early investors are often restricted from selling their shares for several months. This helps prevent millions of additional shares entering the market immediately after the IPO. Eventually, these restrictions expire. When that happens, more shares become available for sale. Basic economics tells us that if supply increases while demand remains the same, prices can come under pressure. That doesn't necessarily mean the business has become worse. Often it's simply early investors taking some profits after waiting years for the company to become publicly traded. Understanding this process helps explain why some IPOs become volatile months after they first list. Let's look at some of the most common mistakes investors make. Buying because of fear of missing out, believing every IPO will become the next market superstar, ignoring the company's valuation, investing without understanding how the company actually makes money, putting too much of your portfolio into one exciting opportunity. These mistakes often happen because emotions become stronger than research. Successful investing usually rewards patience far more than excitement. Many experienced investors choose a different approach. Instead of rushing in on day one, they wait. Waiting allows the initial excitement to settle. The company reports its first financial results as a public company. Analysts begin publishing research. The market develops a clearer understanding of what the business may actually be worth. Sometimes the price continues rising. Sometimes it falls significantly. Nobody knows for certain, but waiting allows investment decisions to be based more on evidence and less on emotion. This doesn't mean you should never invest in an IPO. It simply means you should invest because the business fits your investment strategy, not because everyone else is buying. Before buying an IPO, remember these 5 questions. 1. Is the business one you genuinely understand? 2. Are you buying because of research or because of hype? 3. Does the current valuation seem reasonable? 4. Would you still buy if nobody else was talking about it? And finally, 5. Does this investment fit your long-term plan? Remember, successful investing isn't about buying first. It's about buying well. Understanding IPOs can help you avoid one of the most common investing mistakes: confusing excitement with value. Every successful investment begins with understanding what you're buying, why you're buying it, and whether it fits your overall financial plan. If you found this video useful, please click the subscribe button. It costs you nothing, but it really helps the channel reach more people who want to become better investors.